So we talked about three-party and we talked about hypothecation, right? We're given a collateral on the house, but we're not giving up possession of it, but we're using the collateral on it. So and basically we're saying, hey, look, if we don't pay, you can come and take it. So the trustee is going to hold that third-party piece of paper, that deed of trust, and they have a power of sale clause in there. They don't even have to go to court. They can just sell it. And it has to be by auction, all right? That's the law. But they can just sell it. So it's no big deal. Well, it's a big deal if it's your house, but for them, it's just moving money, moving paper from one place to another. So not the end, it's not very difficult for them. So we talked about the deed of trust. That's what you have. We talked about hypothecation, and the deed of trust is the security instrument. So the deed of trust here pledges the property as collateral to secure the loan. We're going to hold on to it. We're going to live in it, but the property is pledged to that says that I'm going to pay for it. All right. On that deed of trust, on that mortgage, the parties have to be clearly identified. Who are they? James Thomas Jones and his wife, Mary Catherine Jones. Very, very clear and specific. Okay, particularly if you have last names that are relatively usual. And it has to have that proper legal description. Remember, we talked about meets and bounds or lot, block, and section number. All right. So when we see that, this deed of trust is going to have that in there. It has to be in writing, and it has to be signed by the buyer. And the buyer is going to be obligated, right? They're the party to be charged. So that's why the buyer has to sign it. Mm-hmm. And it has to be recorded and delivered to the lender or the trustee. So this will be recorded. This deed of trust will be recorded. It says you owe the money and you're paying it back as such, and you will continue to do so. Now, if you're the borrower, not only do you have to pay back the money, but there are some covenants in there that you must maintain in order to keep your mortgage, okay? So the first is you have to repay the money. We know that. We've taken that for granted. The second thing is that you have to pay your real estate taxes on it. If you don't pay your real estate taxes on it, they can sell your property. They can default your loan. Okay, so you have to keep your real estate practices up. The third thing is you must keep adequate homeowners insurance on the property. Flood, wind and hail, homeowners insurance. If you lapse in your insurance coverage, the bank is going to do what's called forced placement. All right. And they're going to place insurance on you. And I promise you that it's not going to be from the get-go. It's going to probably be from one of them, like a Lloyd's of London, where you're paying premium, right? So you're not going to get a discount. So the best thing you can do is pick your own mortgage insurance company and make sure that you keep your insurance paid. Otherwise, they're going to force pay it, and they'll probably make you escrow it. As it is, they'll make you escrow flood insurance. If you have flood insurance, you're going to have to escrow it. So pay the debt, keep the real estate taxes, maintain adequate insurance. You also have to maintain the property to the value of which it's borrowed. If you borrow $200,000, the bank doesn't want a property back that's worth $130,000. You got to keep it maintained, right? Keep the house up maintained, keep the roof and structure, keep the grounds nice. It's got to stay at value, right? And the last one is if you're going to make any major alterations, you're supposed to let your bank know. Maybe you're going to tear off a garage. Maybe you're going to change some structures. Maybe you're going to add some things, all right? But you should get authorization from your lender also. Now, I got to be honest with you. If I'm putting a room on in the back, I'm not calling my bank unless I need money, right? But technically, I should be. Technically, I should be, all right? So those are the 5 things that go along with your mortgage or your deed of trust, all right? Repay the debt, real estate taxes, adequate insurance, not allow waste, and authorization for major alterations. Those are critical. Those are 5 parts of that. Things we don't always think about. If we fail in any of these, we are defaulting. they can come and take our house away. They can sell it at auction. They have the power of sale. They can invoke that. All right, now, last point there, a satisfaction of mortgage issued by the lender when the debt is paid in full. Remember we said that this was going to be recorded, right? So you have a recorded lien against you for the mortgage, for the deed of trust. Well, you sell the property or you pay it off. You're still, until they file a satisfaction of mortgage with the Registrar of Deeds, it's going to show up on your credit report that you still have a mortgage. So they have 90 days, in some cases 60 days, depending on the situation, to get what's called a satisfaction piece to the Registrar of Deeds and say that you have paid this mortgage off and you no longer have it, okay? So it does take them a little bit of time, but they will give you a satisfaction piece when this thing is paid in full. The rights of the lender. The very first thing is they can sell your debt. How many of you started with one bank and finished up with another, right? You can do that. They can sell your debt, right? You end up working through one bank and then you end up writing checks to somebody else, right? If you default, they can proceed with a foreclosure if you don't make your payments. Now, foreclosure in most states, it's a judicial foreclosure. Not North Carolina. It is a power of sale clause in the trustee. We've said that a few times now. Power of sale clause down there. You see that North Carolina flag? This is a non-judicial foreclosure. The buyer and the lender agreed in the deed of trust that they don't need court proceedings. They don't have to go to court. They could just sell it at an auction. Just sell it at an auction. If a husband and wife are buying as tenants in the entirety, remember they both have 100% of the property, an undivided interest, and only one spouse signs the mortgage note, both spouses still must sign to sell them, to sign the mortgage or the deed of trust, okay? So one person can get the mortgage, but both are gonna have to sign the deed of trust because they both have ownership. Now I can give you an example of that. If you start out in real estate, let's say you have a significant other that you're buying with, and in this particular case, a spouse, because that's the only way you can get tenants by the entirety. If you have that, let's say you're starting out in real estate and you're not really bringing in, you're not showing any real net income because you're writing everything off and you're getting started and you're doing all that other stuff, and business starts slowly. But you have a significant other who is making money enough to get a mortgage. That person can get the mortgage on the house, right? And yeah, that mortgage in that particular case, that person can get that mortgage. It's just that both of you, the mortgage would be in their name, and both of you are just going to have to sign the deed of trust, right? So that's really all that's happening there. You're going to have to both sign on it. But it would be qualified based on the other person. You wouldn't even be part of it. That's how I got my first mortgage, as a matter of fact. So it works out. And then we just refinanced once everything was working out, and we were fine, right? Yeah, Reagan, that's probably what happened with you, right? They just kind of you take one person or the other, whoever's got enough to qualify for the mortgage, and then they just, instead of trying to, it kind of cuts the paperwork in half, right? You just work with the other person. So that's okay. That works, right? Especially if you're self-employed. If we're self-employed, as you will be with as a 1099 employee, the banks wait until you start establishing yourself a little bit. But if you have a spouse who's getting paid on a W-2, it usually helps. So just use theirs. All right. However, both of you are going to still sign. All right. So we have judicial foreclosure. We have to go to the court and bid on our property back. North Carolina is a non-judicial foreclosure, power of sale foreclosure, all right, because there is a power of sale clause in this deed of trust. It must be done at a public auction. Has to be done at a public auction. I still have a right of redemption. If they are going to foreclose on my property, right up until they foreclose, I have the right to come up with the money for foreclosure, and I have the right to pay the fees and get my house back. Now, probably I would have to pay off the entire mortgage, not just what I'm in arrears for. I'd probably have to pay the whole thing off. All right. But it's one way to keep my house, right? I can go there. So as long as they have not auctioned that house off, I can reclaim it. All right. What is that known as? What is on the courthouse steps? Not necessarily, no. What's known as the courthouse steps is what we do in South Carolina, where they'll have an auction literally at the courthouse. And you have to go back and everybody has to buy, and particularly the banks themselves, all right? So this is just a straight power of sale. There's no courts involved. No courts involved. South Carolina, literally, if you're a bank, let's say you were a Truist Bank in South Carolina, and you've given a mortgage to somebody, and you've also given them what? You gave them the deed. On the first of every month, if they go into foreclosure, you have to go and literally outbid somebody for that property, for your own property money. So you have to go to an auction. Very first mortgage auction I went to, foreclosure auction I went to, it was back at the beginning of 2010, and it's at the third floor in the courthouse, and they have it every first Monday of the month at 11 o'clock. There were 375 houses that were going to get sold at auction that day. That's how bad 2010 was, and that was 1 month. And a friend of mine and I were there, and we were watching this auction going on, and the master of equity is literally calling it just like an auction. And they were going, hold on to your hats, 35 seconds apiece. That was the average. Boom, boom, boom. Somebody would come up, a house would come up, and somebody would throw out a junk bid. And then immediately after that, the bank that was holding the note bid on what their fees and what their costs were going to be to recover it. And then nobody was getting a deal anymore. So the bank just won the bid. And usually it was the banks taking their property back. 35 seconds apiece. We were timing them. It became, it was a game to us because we didn't have anything to lose, but it was sad. All of everybody's hopes and dreams went out the window in 35 seconds. Think about that for a second. But for the grace of God go I suppose. Right? Not a pleasant situation. Now here in North Carolina, it's just we're going to have a public auction. Willie's Auction House in Cold Beer. We're going to have an auction on this house on this particular day. Be here at 10 o'clock. And that's when they have the auction. We don't go to court at all. Right? So that is the difference. And it's a pretty big difference. So that's a judicial foreclosure. We do not. We have a power of sale foreclosure in North Carolina. Now, hasn't auctioned off yet. I found the money. My grandma gave me a bunch of money. So I'm going to go and I'm going to buy my house back, and I'm going to give that. As long as I haven't auctioned off the house yet, I have that right of redemption. I have the right to get it back. So let's say that the auction's over. Boom. Wayne won the auction. And now what's happened in North Carolina, what they have is what they call an upset bid period. So anybody has 10 days to come in after Wayne won the auction. Anybody has 10 days. Shanta says, I really like that house Wayne just won. And it's only like 3 days after. As long as we're inside that 10-day upset bid period, Shanta, who had no relationship to the house, comes back and says to the court, or to the auctioneer, I want that house, and I'll pay 10% more than what Wayne paid. And it doesn't have to be 10% more, it can be whatever. And now what happens is, not only as me, it was my house, I had the 10 days that Wayne had an upset bids period. I had that period of time to come back and get my house back. But now after day 4, Shanta came back and upset Wayne's bid. And Shanta's now got a 10-day window. And I still, while Shanta's in that window, I still have the opportunity to come back. And then if somebody else comes, Hunter comes in and says, hey, I want what Shanta just bought, and I'll pay 5% over what she just paid for it. She upsets Shanta, starts the 10 days all over again. And guess what? I still have 10 more days till Hunter's upset bid closes, right? So every time we get a new upset bid, I get an extra 10 days. Until ultimately Hunter's got the property and nobody's taking that property. After that 10 days happens, there's nothing I can do. It can be a long process. Yes, it can be quite a long process. So, and that's what happens. We have these upset bids, but we had that redemption period after the auction, which is that upset bid period. And that's what we're talking about here at the flag, right? Each upset bid restarts that 10 days, boom, right? And while we're doing it, the borrower can still redeem it, find the money and give it back. Does it have to be a certain amount, or it can be literally be $1 more? It can be right. It can be usually just $1 more. Now they're going to have to pay court fees and all other kind of, fees that go along with that, but it doesn't have to. It can be more. It can be more. All right. It doesn't have to be a certain amount more. Not that I know of. Now, here's the thing. Hunter bought that property for, let's say, $100,000. You owed the bank $125,000. So the bank gets the 100 grand from Hunter. They're still 25,000 short. So you think they're going to just say, hey, you know what, Sam, I'm going to give you a gift. Don't worry about it. No, they're going to come to me and they're going to say, okay, we got 100,000 of it, but you need to pay us the other 25. Let's set out a payment schedule so that we get our money back. And I have to pay the balance. Now, there have been some times where these deficiency judgments have been excused. $10,000, $15,000, $20,000, whatever it is. So let's say the bank, it was a $500,000 house and there was $20,000 still left that they didn't get. And now they want, I owe still $20,000. The bank will say, look, it's not worth us to come and get you the $20,000 from you. We're just going to, we're going to give you a grace. We're going to let you go. We're not going to file a deficiency judgment. We'll just take the money we got. The immediately after you get that $20,000 break from the bank, they report it to the IRS. And the IRS sends you a 1099 at the end of the year that says, you got a gift for $20,000. You owe us taxes on that money. No free lunch, folks. Somebody got to pay for it, right? So you're either going to, now it won't be the $20,000 that you owe them, but you won't have the house anymore either. And to add insult to injury, now you got to pay taxes on the gift, if you will. All right. So, you know, that's how the circle works. In one hand and out the other. All right. Now, if we have seller financing, remember we talked about installment land contracts? If we have seller financing, we cannot have a deficiency judgment. All right. It is illegal on, if I sell that property on with seller financing, I can't go back to the buyer and get the balance of the money. Okay. On seller financing, you may not have a deficiency judgment. It's not allowed. Back in 2007, 8, 9, particularly in 8, 9, and 10, we had this thing called a short sale. We still have it, but it was the hardest thing we ever had to do. And what happened was at the peak of the market in 2006, the calendar changed to 2007, and about 2 months into 2007, somebody shut off the real estate market. And the market in 2007 literally fell through the floor. Houses were losing 35 and 40% of their value in 2007. People were buying at the peak of the market. So something that was purchased for $200,000 in 2006 was now worth about $160,000 in 2007. But the mortgages, they were getting what? They were getting 100% mortgages. They were getting no document loans. They were getting what I call ninja loans. Ninja loans are no income, no job loans. They were getting money, just interest only. They were getting money, 125% financing so that they could put furniture in the house. So I bought a $200,000, not me, but they bought a $200,000 house. They got a loan for $225,000 so they could put furniture in it. And now they have a house that's only worth $160,000. Is that a problem? Yeah, I'm thinking it's a problem. And for us that had lived through it, it made the banks go crazy. And people, this created the big mortgage crisis in 2007, 2008. Has anybody seen the movie The Big Short? If you have not seen the movie The Big Short, I would strongly recommend that you see it. It explains, as close to layman's terms as they can get, what was happening. So anyway, these banks started to default on all these garbage loans that they were given. And the truth is that the people were trying to sell their house, but if I had owed the bank $225,000 and I can only get $165,000 for my house, the bank wants what? They want the $225,000. So what was happening was people were just stopping paying. They were just saying, then take the house. I'm foreclosing. Forget about it. Prior to that, it was a pretty big stigma to foreclose. But once that happens, people got fed up and they just didn't pay. So the banks were acquiring all these mortgage foreclosures. Short sales come about. What happens is this. I'm a good payer, right? Mortgage, if you're a good payer, it's not fair that the two people down the street decided to just quit paying and go to foreclosure, right? Not fair. I'm paying my mortgage. I'm doing the best I can. I'm upside down. But something happens. I have a hardship. I lose a job. I get sick. I got transferred. Anything. I get a divorce. Any of those things. If I can prove that hardship and keep paying, what I can do is go to the bank and ask them for a short sale. So what that means is that I got a buyer. I have to get a legitimate buyer with a contract for $165,000, whatever the market will bear. And I have to go to the bank and say, hey, look, I owe you $225,000. I understand. However, I have a legitimate contract for $165,000. I have been a good payer, but I have this hardship. I can't possibly pay you anymore. Mr. Bank, will you accept the $165,000 and let me loose on the balance of the mortgage? So the bank was either going to have to get what? $165,000 or what? They were going to foreclose. And that because they weren't going to pay the mortgage anymore. So the bank had to make some decisions and basically say, all right, what do we have to do? But there were so many of them that you couldn't get them through. They just took forever because the bank had so many of them. They didn't want everybody's house at a loss. And people were paying. And then the foreclosure market went down the bottom. It was just a slippery slope. It was the biggest downhill rush you ever saw. So what happens is now all of these things go into short sale. You never hear from the bank, and then ultimately people just stop paying, or they keep paying and then they forget about the short sale and the deal falls apart. I went to buy a house, my own personal house. I went to buy it in 2010. And I made a full price offer on a short sale. Full price. I didn't negotiate or anything else. Full price. And after 6 months that the bank didn't get back to me, I finally withdrew my offer. 6 months. On a full price offer, I didn't even try to negotiate it. I just went somewhere else. So I know firsthand the frustrations that people were feeling. It just took so long to get these things through. Now, as a real estate agent, as a broker, there are some agents, brokers who are extremely good at dealing with the frustrations of the banks and short sales. And then there were the rest of us who just said, look, I have a short sale. I'm going to get a referral fee. I'll go find the agent who is really good at doing these. I'll give them this listing and I'll just take, if they sell it, give me a referral fee. Pay me a 20% referral fee or a 25% referral fee. And that would be, that would be at least something, half a loaf is better than none or a quarter loaf is better than none. But here's something else that the banks were doing. Because they were losing money on the deal, they didn't want to pay the real estate agents either. So what they were doing was cutting your commission down to like pebbles. All right, well, you know what? We'll pay 1% for the commission. After you divide that up with all of the players, guess what? And waited 6 months to get it worked out. Was that a frustrating circumstance? Yeah, it was. So short sales are not that much anymore. They're because the market's recovered. I'm not going to say it because the market's starting to fall down a little bit. I'm not going to say there's not going to get a little spike in there, but some folks are pretty good at doing it. Find those people who are good at doing it and then let them handle it. Get a referral fee. You'll be a happier person for it. Very difficult. All right. Very frustration. Very much frustrating. And there is a North Carolina short sale addendum that has to go with that if you're going to do it. And there is still a possible deficiency. Some banks would go after you for the difference in the money. All right. And if it is going to be a short sale, that is a material fact. You do have to disclose that. You, by all means, as the broker, may not negotiate a workout agreement with the bank. That is not your job. That is the unauthorized practice of law. You need to get an attorney to work out that agreement. You step aside. All right. You're not the negotiator. You're not negotiating for your client here. Your job is to sell a piece of property. The attorneys, their attorney, will negotiate a workout agreement with the bank, not you. I'm going to talk about 2 points here: a subject to a loan and a loan assumption. Because of the way loans are structured today, and the documentation has changed so much, these two things hardly ever happen. Hardly ever happen. They're still on the books and they still may happen, but your chances of seeing them are pretty remote. Because now the banks have what's called a due on sale clause, all right? And that means that those payments are due, and we'll talk about that after the break probably. The due on sale clause means that if you're selling this if you're selling this house, you need to pay us off, and we'll take care of any new buyer. So subject to, when a new buyer takes over a loan subject to the original owner's loan, the original owner maintains responsibility in the event of the default. So Kimberly's got a loan. She's going to sell the house to me. I'm going to give her some cash up front, and then I'm going to take her loan over. And all I'm going to do is I'm going to start making payments, but it's going to be based on her loan. Her name's going to still be on the docs. If I default, what's going to happen? Who's going to be responsible? Poor Kimberly, right? So in that particular case, I took it subject to her mortgage. Now, the next one is going to be a loan assumption. So let's say Kimberly had this mortgage and I had a great rate on it, and I wanted to assume her mortgage. So I told the bank that I was taking it over from today on. It's going to be my name on there, everything else, all right? And then at that point, Kimberly's not responsible anymore. I am responsible, all right? So when a new buyer assumes the loan of the original owner, the new buyer assumes full responsibility in the event of a default. So we take that loan subject to, the original owner has secondary responsibility for payment. If I assume it, the original owner has no responsibility for the payment. It's all on me. But again, because of the due on sale clauses, because of the acceleration clauses, because of the alienation clauses, these things are, the bank wants their own to check the new buyer for credit rating. They want to make sure they're not going to just give you a loan because you showed up and they're going to assume it. They want to check your credit rating. They want to make sure you're a good payer. They want to make sure maybe they got to get a higher rate now, right? So finance it for a higher rate. So all of those reasons, that's why loan assumptions they don't happen that often anymore. They simply don't. Spend a couple of moments reverting back to this promissory note. Mr. Bank, I need money. I want to buy this house. Can you lend me some money? All right. We're going to need to put some things in this promissory note. The terms. How much is the debt? How long do I have to pay it? And in what kind of installments? I'm going to sign a promise to pay. I promise to pay you back. The mortgage is going to tell me the repercussions if I don't. And all the borrowers or the parties to be charged have to sign it. They're the ones being charged. All right. Now, the promissory note is a contract. It has to be in writing. However, usually the promissory note is not recorded until it is defaulted on. And then once it's defaulted, you're going to get recorded. But usually they don't record it because you're working it off through the deed of trust. The deed of trust is recorded. All right. So the promissory note is not, but it is a contract, so it has to be in writing. Now, these are some of the provisions I was just talking about. These are in the promissory note. The first one is called an acceleration clause. Acceleration clause. What happens when you accelerate something? Speed it up. If the borrower defaults, the lender has the right to accelerate the maturity of the debit, and that makes it payable immediately. So if you miss a payment, and it doesn't have to be any number of payments, it could be one payment. If you miss that one payment, they can accelerate your mortgage to say, okay, you have 30 days or you have 15 days or whatever they decide to pay off the entire remaining balance plus any interest owed in order to maintain your property. Otherwise, we're going to sell it at a public auction. That's because that acceleration clause is in there. So they're going to give you an opportunity to pay the whole thing off next month. Now, the second thing that's in there is a prepayment clause. Usually they'll charge something if you prepay the mortgage, or prior to a year, 2, 3 years, whatever they decide. The banks have all different fee schedules. A couple of things you need to know. If your mortgage is less than $150,000, they may not charge a prepayment penalty in North Carolina. And if it's a VA loan or an FHA loan, they may not charge a prepayment penalty. So a VA loan, FHA loan, and loans under $150,000, first loans under $150,000 may not have a prepayment penalty. Everything else can. Some banks choose to, some banks choose not to. And this third one is our alienation clause. This is the one I was talking about a little earlier. It's also called a due on sale clause, which means that the bank says if you push yourself away from this loan, it's got to be paid in full. You sell it, you got to pay us off. All right. So it says it requires the payment of the entire loan balance when the title is transferred. So if I'm going to sell it to James, I have to pay the mortgage off, right, from the proceeds of the settlement. That's what I have to do. And that's because of the alienation clause. I'm alienating myself from the property. I'm selling it. Therefore, I have to pay the loan off. 3 key clauses: the acceleration clause, prepayment penalty, and the alienation clause. Now, this promissory note is a negotiable note. All right. So that means that your bank can sell it. They can transfer it to the trustee, which they're going to do. They can sell it to another bank who will transfer it to another trustee. They can do anything. It's negotiable. All right. And it can be sold. If it's non-negotiable, they're payable only to a named person. Most of these are negotiable notes. All right. We do not use a bond in lieu of a promissory note. North Carolina does not use a bond in lieu of it. It is a promissory note, but some states may. All right, where they're going to have to put up a bond. Now, if you have a mortgage and you pay it off and you sell it, regardless of if you use a loan or not, they're going to call it a cash sale. Only because it's not a distress sale. It's not a foreclosure, right? It's not a short sale. It's an arm's length transaction. So they're just going to call it a cash sale. So you may see it called a cash sale. Doesn't mean that it's necessarily done in cash. All right. It says, though the term does not necessarily indicate the buyer paid entirely with cash. Typically a result of a cash down payment in addition to the buyer obtaining a new mortgage. And that basically says it indicates the seller's existing mortgage has been paid off. You are going to get a house payment. Lucky you. And it's going to probably consist of 4 things. It's going to consist of principal, interest, taxes, and insurance. PITI or PITI. This is going to be the 4 components of your monthly housing payment. And this is going to come in important when we come to do how much the bank will lend you and their ratios. All right. So the first part of this is the principal is going to go towards the payment of the loan. Okay, self-explanatory, right? It's going to go to the bank towards your house. The interest is the profit to the bank for lending you the money, right? Whatever it costs. Then obviously they're going to escrow your taxes and your insurance. They're going to take that and they're going to put it together. And then when the taxes are due, they'll pay them. And when the insurance is due, they'll pay it. So you don't get, now, in some cases, you'll be allowed to not escrow. Most cases, you're going to just escrow your taxes and insurance. All right. So you make one big payment at the month and it pays for all of these things: principal, interest, taxes, and insurance. So interest is usually payable in arrears. You pay backwards. So if today is, let's say on September 1st, when I make my mortgage payment, I'm paying for the month of August. If I was making my mortgage payment on February 1st, I would make it for the month of January. That would be the month that I'm paying the interest for. So I'm paying in arrears. I'm paying backwards. Okay. And these are amortized over the course of 30 years, 20 years, 15 years over time. You'll have the same principal. You'll have the same payment over time. And I'm going to show you after the break how it works. Okay. Now, any escrow accounts that they have are for future taxes. They're collecting that money now so that they can pay them in the future. Same thing with insurance.
If you like this video, feel free to share it with a friend. For more real estate education content, please subscribe to the channel. From all of us at Seacoast Real Estate Academy, thank you for watching.